Greetings. Welcome back to Happy Half Hour. That's Toby Weber. I'm Nick Shermans. We are talking about AI, markets, economy, the Fed. It's kind of been a lull in the data here the last week or so, but we just got through second quarter earnings. Some tidbits from that. I got some good stuff for you, Toby. I actually did prepare.
Okay, so we've had a pretty remarkable, we've kind of been lulled to sleep, but a pretty remarkable recovery from April. We've also seen a bit of a rotation in July, meaning that the technology US large cap stocks have started to perform better where they were a bit of a laggard to start the year. What do you take from what you're seeing in the market? What do you take from the strong recovery we've seen since April, and how are you looking at the rest of the year? And as usual, I like to fold in 4 or 5 questions into one question.
Yeah, I'm trying to unpack what to answer first. I think one thing that sticks out is the speed at which we bounce back. You think COVID, you think April 2025. That's not normal when you look at history. Like, I think the second quarter was one of the quickest bounce backs, meaning we went down just as fast as we went up. And people are conditioned to buy these dips now. Anytime the market sells off, the retail investor is shoveling money into the market. And when you looked at how institutional investors were positioned, they're still underweight equities. They're not a believer of this rally, but retail has been out in front of it. They've been right. So speed is one. The second thing is how, and you touched on this, seemingly complacent people are now. I always say this, but price drives sentiment. When price is down, people think the world's ending. When price is up, people are carefree. They think that's a good time. If they had cash on the sidelines, if they want to get more aggressive. I wrote a post back in, during the throes of the crisis and said that there's few fat pitches in investing. One is putting capital to work when it feels uncomfortable. I think that's still true, but investors often do the opposite. And now we're getting people saying, oh, maybe we should take more risk, or, it looks like it's all clear now. That's not really how investing works. And folks should put that cash to work, get more aggressive when it feels the worst.
Yeah, I think my concern is people are almost conditioned to buy the dip, and they're almost conditioned that if I don't buy it quickly, I'm going to miss out on the recovery, even if it's only a 2-week blip that went down or a week blip that went down. I have people that I talk to, friends, family, others, that are like, oh, well, it must be a good time to buy because the market pulled back 2%, 3%. And my only fear is that at some point we're going to have a more meaningful correction, and that buy the dip strategy isn't going to work as well as it has the last couple of years.
Yeah, this has been the golden age for U.S. investors. If you look at the last 13 years, it stacks up just as good or better than any rolling 10-year period, 12-year period in history. So I think U.S. investors, especially the large cap, the in vogue names like big tech, are a bit spoiled. And I think our expectations sometimes can be a little out of whack with reality. We talk a lot about how we're actually valued right now, and current levels of valuation for U.S. large caps are at historically rich levels. And future returns from those levels are quite low, from 0 to 3%. So back to my comments to open this year, I was like, U.S. large cap investors should revise their expectations down because we're priced to perfection. There's opportunities in other equity asset classes. You look at emerging markets, you look at foreign stocks, up 15, 20% this year. Still, that's a pretty good setup. I've heard some folks say, hey, foreign stocks have had a great run. It's like, no, when you zoom out and look at the last 10 years, they're still abysmally cheap relative to U.S. large cap stocks. I've got a question for you.
I'm ready.
Can you tell me, and this isn't designed to baffle you or embarrass you, but how much collectively the Mag 7 companies are spending on AI infrastructure in 2025?
I'm going to say they're spending $500 billion.
That's close. $300 billion to $350 billion in 1 year alone on AI infrastructure, which is absolutely mind-blowing. I went back to the 90s during the Netscape boom, the internet boom. And sure, companies were investing in the internet and their websites and their digital offerings and online stores and all these things, but it wasn't even close to these numbers. And part of it's impressive that they have the capital to allocate. And the other part of it is something I've touched on before, is at some point people want to see a payoff from this massive investment. And it's crazy to see now companies that are deemed behind, even if they have blowout earnings. We just got through second quarter earnings. They're getting punished if they're deemed to be behind in the AI race. So it probably gets more intense from here. The investment gets more intense from here. But at some point, and I don't know when that point is, investors are going to want to see a payoff.
Well, and it's a good reason why the Mag 7 are the ones doing the investing, because they have the cash from their core businesses to invest. But I think I read something that Meta's cash position went from 100 billion to 20 billion in the second quarter because of all the money they're spending. So the good news is they have the cash. But to your point, at some point, we need to see a return on that investment. And I'm not so sure they're as concerned about that as they are about not falling behind.
Exactly, exactly. And then you pulled a stat, which I thought was quite amazing. And I don't know if you have this on your notepad, but the percentage of NVIDIA employees that are millionaires.
Yeah, I think I read something that it's those that are millionaires is 50% or 25%. I can't remember.
Roughly 50% of NVIDIA employees are now worth over 25 million. 80% are now millionaires.
Right. Yeah, staggering.
That is staggering.
Well, they're the beneficiary of all, not all, but a lot of that spending by the other Mag 7 companies is going into NVIDIA chips and servers, et cetera. So they're the beneficiary of that, and their stock has been a juggernaut the last, 4 or 5 years.
And it's not just NVIDIA employees. So Meta has been throwing money at OpenAI engineers, pretty much anybody with a reputation for building AI models and refining AI models. They just offered a 24-year-old PhD dropout, Matt Dickey, I hope I'm saying that right, 4-year deal worth $250 million. Like, that's Patrick Mahomes, LeBron James money.
It's pretty staggering. And a lot of these people are not taking it, but just the fact that they're getting that offer is just mind-blowing.
Okay, let's touch on second quarter earnings. I don't know if you followed this, but did you have any takeaways or observations based on what you see?
No, I think earnings generally, from what I've seen, have been pretty good. Most companies have performed well in the second quarter. Sometimes they give guidance that isn't as strong as it needs to be, and those companies seem to be getting punished when that occurs. But earnings themselves in the second quarter, were pretty solid.
Yeah, and I think CEOs and CFOs are good at gaming the expectation game, if you will. So every quarter, companies give guidance, and I think the narrative was, with tariffs looming overhead, the market sell-off, a lot of companies guided lower or said it's too uncertain to guide. And then at the end of June and early July, when they published earnings, they came out better than expected. The market likes better than expected. But one interesting nugget that I saw consistently when CEOs and CFOs were talking on these earnings calls was they weren't necessarily passing the additional tariff cost on to the consumer. It was eating margin. So that means companies were eating the tariff costs. And you think about it, a lot of US consumers are tired of paying $5 for something that used to cost $3. And I think I don't know if tapped out's the right word, but there's less of a willingness or capacity to pay up for stuff. Companies understand that. Some of them lack pricing power. So it's interesting that companies are eating the tariff, hasn't flowed through to consumer inflation. I'm not saying that can't happen, but certainly companies have bore the brunt of the tariff tax, quote unquote.
Well, and the tariffs are still being rolled out, so probably the full effect of tariffs wasn't seen in its second quarter earnings. That's probably more a third quarter, fourth quarter story moving forward. So that maybe that's why the guidance has been light in some cases. So I think that story still has more room to go.
Okay, and I don't want to get political, but what did you think of the White House firing the BLS chief who's in charge of the jobs data reporting?
Yeah, it's probably best if we don't get political, but I just think if the number is what the administration, and that doesn't mean the Trump administration, it could mean the Biden administration, if the number is what they want, then they trumpet it and look at what we did, look at how great of a job we're doing. If the number isn't what they want, it seems like that's, who do we blame? Oh, the number's not good. They were withholding things. They were gaming the system, monkeying with the numbers. So they like to have it both ways, and that's not a political statement. That's just, unfortunately, the reality we seem to be operating in.
I've been tracking the jobs data, and many investors have, since the start of time. And I don't remember a point in the last 20 plus years where we've had these massive revisions, meaning the government will publish a number and they'll go back and it'll be like 90% off. So I think you can go back to the way they capture the data is flawed. And you can say this not just for the jobs data, but inflation data. And what the government does is they basically call on businesses to get their head count. Like, did you fire? Did you hire? Did you keep your head count? And it's a very old school, antiquated approach. And I think as the economy has evolved, a lot of these government data gathering tactics are left behind. So I think what the White House was doing, like, hey, these numbers are wildly different than what you publish 3 months later, and they're looking to revamp the way the data is captured. Now, the conspiracy theorists will say pre-election, post-election, there's some shenanigans going on. I'm not going to go down the rabbit hole, but certainly you could say, and many investors have said this, they need to revise and modernize the way they collect this data. In an era of AI, it should be a lot more accurate than it has been.
Well, you might not know this, but we actually contribute to those surveys, Pure Portfolio.
Oh, really? I did not know that.
Yeah. So we share information about the future plans and future trajectory of our business and any hiring we've done and our outlook. So we're part of the group that participates in that survey. And obviously we try to answer it as best we can. But yeah, it does seem like a pretty antiquated way to do it.
I was going to say that you game the numbers based on your political beliefs.
No. Okay. I want to get fired. Okay, I've got one for you. Everybody's favorite asset class corner. Give us an update on bonds and how you're seeing bonds have actually performed fairly well this year, especially the shorter duration, intermediate duration stuff. How are you feeling about bonds, and how do you think they look sitting here in August 2025?
Bonds look pretty darn good. And not only are they producing income, right? Starting yields are right around 4 to 4.5%. Of course, the 7 to 10-year bond yields have come down a bit as growth and inflation has come down. But still, bonds are a decent place to be, not only for the income, but they're starting to resume their historical hedge against most people's riskiest asset class, and that's equities. So if you look at April 2025, bonds actually held up quite well when the equity markets were down by 20%. So zooming out a bit, 70 to 80% of our clients are retired. Bonds are going to be a staple in their investment portfolio, because when the stuff hits the fan, if and when we do get a recession, bonds, high quality bonds, I'm talking munis, corporates, treasuries, all act as a safe haven. And, despite what you read on the news, when the stuff hits the fan, investors, domestic and foreign, still want to own US dollars. They still want to own US assets.
Yeah, and fixed income ETFs and products that we've owned this year in the first 6-7 months of the year, up 2, 3, 4%. That's not an annualized number. That's a pure number. So that's a pretty good result. We're not necessarily owning bonds for the high returns. They act as a risk reducer in the portfolio, a bit of a ballast in the portfolio. So they've been a pleasant surprise this year, along with international emerging markets, gold, etc. But bonds have certainly held their own in 2025.
Okay, let's talk about the Fed. The Fed's been on the front page of the news: politics, investing, interest rates, inflation. We got a soft jobs report back, and the odds of cutting. So there's a website out there. Like, a lot of people think that you just guess on what the Fed does next and the markets has blinders on. There is a market out there where smart investors bet with their capital on what the Fed does next. And after we got that soft jobs report last Friday, the odds of a Fed rate cut in September went from 40 something to 90 something percent. So it looks like the Fed is going to cut in September. And if you go back to the start of the year, the expectation was the Fed was going to cut 3 or 4 times. The data came in a bit better. Then you had tariffs. So what I'm saying is markets are very much, and the Fed is very much a follower of the economic data. And we said last time during this podcast that it's pretty rare for the Fed to cut when markets, Bitcoin, real estate are all at all-time highs. Now you're starting to see some cracks. If the economy slows down, you would expect the Fed to cut. And just a reminder, they have a dual mandate. So they're looking at inflation and jobs. Inflation has been above the Fed's target for like 4 years now. Job market is starting to show some cracks. So if the stuff does hit the fan, you would expect the Fed to cut rates a bit more aggressively than the market is pricing it.
Yeah, I think that's fair. And I think the holdout, as you mentioned, is inflation. I think the Fed is concerned that inflation has not come down to their target, and they still have tariff impact to go, which could push inflation numbers higher. So I think they're being cautious. And to your point, I don't think they see a need to cut with everything kind of hanging in there and performing well near all-time highs. So, but I also think there'll be political ramifications too. I think Trump is not going to renew Powell's mandate next year and keep him in the job. And I think whoever he puts in that job is also going to be focused on lower rates. So I think lower rates, or at least cuts from the Fed, are likely coming. Whether it's this year or next year, I think that's probably the next action they take.
Well, and look, I know Trump gets a lot of flack in the media, but a president pressuring the Fed chair is nothing new. This has been happening for 50 years, and I have a couple of examples. So Nixon pressured Fed Chairman Arthur Burns to keep rates low ahead of the 1972 election. Reagan pressured Paul Volcker in the 80s to cut rates. Remember, rates were 15, 16%. Bush, the father, the older one, H.W. Bush, blamed Greenspan for not cutting rates fast enough during the 1990-91 recession, and he blamed Greenspan for losing the 92 election. So I know we like to sensationalize things, but some of these themes, the death of the US dollar, the death of US Treasury bonds, the president meddling in an independent Fed, this is nothing new. This has been going on for 50, 60, 70 years.
Well, and I thought it was very generous on the president's part to go visit the Fed recently and see the progress on their construction of their new building. He's got a lot of experience in that area, and I thought it was nice of him to go and lend his comments to the Fed and their work over there.
You're talking about the remodel, and you're being tongue-in-cheek, or?
Yes. He went over there, they put on the hard hats, they walked around, and I think he was just wanting to point out to everybody that they're spending $3 billion on a remodel of a Fed building that maybe isn't the best thing. Although this is coming from a president that's in the process of building a ballroom in the White House that's going to be a $200 million expense as well. So,
well, there are some people that think the Fed should go away, and I tend to lean on that side. It's better if markets dictate where rates are. The Fed is not had the best track record over the past, I mean, you can go back 20 years, but certainly in recent history, in 2021, they were much too slow to raise rates. Some people think they're much too slow to cut rates. And again, the Fed is not making forward-looking policy. They are very much reacting to the data, reacting to what the market is doing. That dual mandate I talked about, you can actually add a third mandate: inflation, jobs, and what the market is doing. They very much pay attention to what the equity markets are doing.
Nope, I think that's fair. We can do another asset class update. There's been cryptocurrency. Bitcoin has been in the news lately. There's been some legislation passed relative to those items. Any update from your perspective on how important that is for the cryptocurrency space? We've certainly got a lot more questions coming in to Pure from clients and prospects about cryptocurrency and whether it should be part of a portfolio. Maybe just give an update from your perspective on where things stand with Bitcoin and cryptocurrency.
I'm writing about Bitcoin this week, the crazy train, as I'm calling it, where the mass adoption is accelerated. And now states, US states, are talking about creating their own Bitcoin reserves. Countries are starting to do this. Brazil's got a bill in the Senate. Italy's got a bill where essentially their central bank or their government would buy Bitcoin and hold it on their balance sheet as a store of value. Because a lot of these countries, the US included, keep on running deficits. They keep printing money, debasing their currency, running it higher than their inflation targets. People are sick of paying up for goods, and a lot of that has to do with central bank policy. So sound money is gold and Bitcoin. You can't create them out of thin air. People like the store of value. They like that you can't print more of it. A bureaucrat can't mess it up. So I think one thing that's not going to change, and I say this all the time, people ask me what's going to change. I think a better way to look at this is what's not going to change. What's not going to change is governments spending like drunken sailors. And you want assets in your portfolio that have sound money principles that can outpace inflation. So I keep coming back to three: gold, Bitcoin, and stocks. If you have a long-term time horizon, and I'm not necessarily talking to our clients because a lot of them are older and they're retired, but if you're in your 20s, 30s, and 40s and you have decades to invest, those three asset classes should be cornerstones or staples of what you own if you believe that the reckless spending is going to continue.
Makes sense.
Has your opinions on Bitcoin changed at all with the adoption, with the price movement?
I don't think you can argue with how mainstream it's becoming and how many people have their livelihoods or hands into the cryptocurrency and Bitcoin space. I still think it suffers from the same challenge as gold, which is it's an asset that you're hoping holds value and increases in value as the value of the dollar declines. But if we get to a point where you're using Bitcoin as a medium of exchange, it probably means something significant has gone wrong. Just like people say, hey, own physical gold. Well, if I need physical gold to be able to live my life and transact my business, something's probably done terribly wrong. So I think I'd put it in the same basket as gold, which is probably makes sense to own it. But I think there's still some concerns about, the use of it moving forward.
Yeah, and I have had this conversation a lot with people, and I think what's important to note is a dollar is only a dollar because you and I agree that it's a dollar. If enough people believe that Bitcoin is a medium of exchange, a store of value, a mature asset class, then it takes a spirit of its own, and I feel like that's happening now. Like you look at these, what's the Diamond said Bitcoin was rat poison a couple of years ago. Now they're launching their own blockchain. They're allowing their clients to buy Bitcoin. I think they're allowing their clients to trade Bitcoin options. So they're going full send on Bitcoin. And a lot of these older, I have to be careful what I say, but these older traditional institutionalized investors that have been around a long time are starting to change their mind on Bitcoin. Governments are starting to own it on their balance sheet. Companies are owning it on their balance sheet. It really is a juggernaut, and it's taken on inertia of its own. And I never thought I'd see the day that a president or a government would be endorsing Bitcoin.
Right. And you're referring to Jamie Dimon,
Jamie Dimon.
JP Morgan Chase chairman.
That's right.
Yep. No, I think that's very telling. And I think for some folks, it's a matter of not fear of missing out, but fear of being wrong. Like if the projections for Bitcoin of, hey, it's going to 1 million or it's going to 5 million, if those are even partially correct, why wouldn't I just buy a little bit of it now so that I'm not the only person that doesn't own it? So, but it also has to be right. It's a highly speculative asset, highly risky asset. So, obviously in a lot of our client portfolios with folks that are retired, it doesn't make sense. It doesn't fit their risk profile. But as you say, for younger investors and people that have the risk tolerance and the runway, it can make sense to include it in the portfolio.
And let's be candid. The people who are early and talked about the Bitcoin thesis, they've been overwhelmingly right. They had been right. And even if you don't like Bitcoin, I feel like some people in the digital age, when we're fighting on the internet, would rather be right than make money. And the Bitcoin holders, the maximists, those that have believed in the thesis long-term have been overwhelmingly right. And I said this last time, if your advisor dismisses Bitcoin and says, the traditional lazy responses, oh, criminals use it, it's a Ponzi scheme, what else are they not open to? Like, to me, at least understand it, be open to it, and know what you're talking about, because it just is a canary in a coal mine almost to being shut off to other ideas and open to other investment possibilities. The modern investment portfolio of the next 10 years is going to look different than the last 30 years. And I think an advisor has a fiduciary duty to be open to everything.
Nope, I agree. I know summer movie. Have you seen any of the Jurassic World, Superman, Fantastic Four? I'm missing one or two. F1 with Brad Pitt. Any summer movies with the kids that have jumped out at you or that you've enjoyed, or you're staying away from that scene?
This answer is going to disappoint you, but I have not sit down and watched a full movie, maybe one in 8 or 9 years.
Really?
I just don't sit down and watch movies. If I watch a movie with my wife or kids, it's in like 30-minute blocks. So we'll watch it over 3 or 4 days.
But not even the kids? The kids don't drag you to different movies?
My wife went to a movie with the kids. My daughter and her friends went last night to Bad Guys 2. Is that a movie?
Sure.
Okay. So my daughter and her friends went last night. The last movie I took my kids to was Sing 2.
Sure.
And I sat through the entire thing, and that was a couple of years ago.
Okay.
How about you?
We've seen almost all of the movies this summer. I don't know why. We're not necessarily movie buffs, but we've seen all the summer movies. Superman was good. Jurassic World was kind of what you expected. F1 was really well done with Brad Pitt. It's kind of an interesting world, Formula One racing. So yeah, there's some entertaining things out there that we've enjoyed this summer.
Well, good. Well, we hope everyone's doing well out there. That's it for Happy Half Hour. We can't go over a half hour, so we will see you next month. If you have any questions about the way we manage money or work with clients and how we're different than other advisors, shoot us a note at insight@pureportfolios.com. We'll see you next month.
Cheers.